So welcome again to this particular session, and as I promised in the last one that whatever discussion we have had in the first one or the second one, we are going to write it in black and white in front of you, completely comprehensively. Although in this particular session I'm not going to have any discussion because most of the things I have already discussed, only thing is that we are putting them into black and white. So here we go and start this session. Correct? So you are well aware of the objective of the standards, so let's write here. Standard, whenever I would say standard, it means IFRS 3 or India Standard 3, correct? Standard provides some guidelines, and you will have to write along with me. Guidelines, correct? And establishes, as I said earlier, and it establishes it's pretty cold out here, so it takes a bit of time before we get into the groove. Establishes principles and requirements all these things we have already discussed, isn't it? Requirements for an acquirer with respect to recognition and measurement of one identifiable asset. We have already seen that all the identifiable assets we need to recognize and we need to measure them. We already know that rule now that all the identifiable assets are measured at fair value. Second, liabilities assumed. Third, non-controlling interest. Non-controlling interest, I did tell that there is an option available with the entity. We will take up this particular point later on also, that entity can measure it at fair value or on proportionate basis. Goodwill or gain on bargain purchase. Gain on bargain purchase. We will use this term so often, so henceforth I will use the abbreviated form, that is GOBP, gain on bargain purchase, correct? So it will save a bit of time. Then I did tell you during the discussion that Ind AS 103 will come into play only if the transaction or event will meet the definition of business combination, isn't it? So we write here, Ind AS 103 applies to a transaction or event that meets the definition of that meets the definition of business combination. Definition of business combination. We explained that particular point, isn't it? So I need not require to do any explanation here. Business combination. The acquiring company must be a business. Third, business simply refers to an integrated set of activities comprising of group of asset group of assets that is capable of being conducted and managed for the purpose of providing returns. I talked earlier also, once again just recapitulating the things. There must be inputs, there must be some processes. I talked about this particular fact. Input means group of asset. While processes means set of activities. Inputs and processes can be integrated to produce output. When we say to produce output, it means some economic benefits. So the acquiring company must meet the definition of business. Later on we will do some case study questions on it. Right now we are simply writing what we did in the last session, correct? Now we come to the fourth point. Term business combination refers to a transaction refers to a transaction or an event in which acquirer in which acquirer in which acquirer acquires control of one or more businesses business combination business combination is also referred to as true mergers. So, Ind AS 103 applies only to a transaction when it meets the definition of business combination, correct? And business combinations are often known as what we call true mergers too. During the discussion, I did talk about the fact term acquirer. You are well acquainted with this, needless to write, acquirer is the entity that acquires control of other entity or entities. Other entity or entities. Correct? We talked about the term acquiry also. We write each and every word regarding which we have had a discussion in the last two sessions, correct? So, acquiry is the entity whose control is being acquired. Now we move over to the next part, accounting. As per Ind AS 103, acquisition method, we talked at length regarding acquisition method during the initial two theoretical sessions. Ind AS 103, acquisition method shall be used for accounting business combinations. For accounting business combinations. Business combinations. As we discussed, that accounting method encompasses some steps, isn't it or not? So now we shall talk about steps. Seven point one. That means this part is basically sub part of this major part. Correct? The first step is identifying the acquirer. Identifying the acquirer. Suppose there is a company by the name of A Limited and there is another company by the name of B Limited. We further presume that A Limited acquired 70% stakes in B Limited. Then, as we discussed even during the first two sessions, that A will be termed as acquirer and B will be termed as acquiree, without any doubt. Acquirer, acquiree. However, technically, A is legal acquirer, that is, in the eyes of the law, without an iota of doubt, A happens to be the legal acquirer, while B happens to be the legal acquiree. However, as per this step, we need to find out the accounting acquirer. Identifying the acquirer means identifying accounting acquirer. We will do some case studies later on when we will move over to the practical part on this concept. Right at this moment, we are simply writing what we discussed in the first two sessions. I did tell during those that it may be a possibility that even though B is a legal acquiree, for the purpose of accounting, he may be considered as an acquirer. Correct? So, that could be a possibility very much. Then, under the acquisition method, the second step is determination of acquisition date. Determination of acquisition date. Determination of acquisition date. Determination of acquisition date means the acquirer will determine the date on which it obtains the control as per Ind AS 103. Acquirer shall determine the date on which it obtains control. And it is not a very tough ask. As we discussed that in the first two sessions. Correct? Now we move over to the third vital step. Do you remember? We discussed the what we call real accounting. Anyway, we are writing for 7.3. Now standard says if everything settles down and the transaction is business combination, then we will recognize third step 7.3, that is third step under acquisition method, recognition of on the acquisition date, the acquirer shall recognize a identifiable asset, as we wrote under step 1 also. Identifiable asset all the liabilities which we have assumed then C, any non-controlling interest, NCI. D, goodwill or gain on bargain purchase. In fact, I am breaking this step further into a new step, 7.4. Actually, both these steps are one and same, recognition and measurement. How we are going to recognize all these items? All the aforementioned items are recognized at fair value. All the aforementioned items shall be recognized at what value? Fair value. If you remember, during our discussion, I did talk about non-controlling interest. So, here I am putting up a separate note. However, non-controlling interest can be measured at fair value or on proportionate basis. Non-controlling interest can be measured at fair value or on proportionate basis. We will discuss this point when we will take up the practicals. Proportionate basis. I did talk about this particular fact, that option is granted by Ind AS. This choice, this option is granted by Ind AS. Correct? Then we also talked about, when we were talking about the measurement, we also talked about exception. I am writing another point for the same. Exception. Exceptions. Exception to recognition principle. We talked about the fact that contingent liabilities, it is an exception, and it is also an exception to recognition principle. Standard says that contingent liabilities shall be recognized irrespective of probability of outflow of funds. It is an exception. We will have to recognize that. General rule is that contingent liabilities are not recognized in the financial. General rule, or as per Ind AS 37. Contingent liabilities are recognized. Recognized means you are putting them in your financials. Are recognized only when there is present obligation, that is obligation on the date of balance sheet. There is present obligation and outflow of funds is probable. Then only you will recognize it as a liability. Outflow of funds is probable. However, as per Ind AS, whether outflow is there or not, whether probability or not, we are going to recognize it. Correct? Then 7.6. Exception to recognition and measurement, both. There are some items which we have to recognize, however, generally we do not recognize. That is why they are an exception. Income tax liabilities, employee benefits, and indemnification asset. Indemnification means compensation. Logically, generally, we do not recognize these items. However, in the light of Ind AS 3, we shall have to means acquirer shall have to recognize these. That is why they become an exception. And further, they become an exception to measurement because shall not be measured at fair value. That is because generally Ind AS 103 states that assets liabilities of acquiree should be measured while incorporating them into the financials of acquirer. We have to, or we are supposed to actually recognize those at fair value. But these items are not recognized at fair value. They might get recognized either at book value or agreed value. Correct? And we have to recognize them. That is why they have become an exception to recognition. We have to recognize them at fair value. That is why they become exception to, as I said, measurement rule also. Besides, we also talked about some exceptions related to measurement only. Exceptions to measurement. To measurement principle. Measurement principle. We talked about reacquired rights. We talked about share-based payments. Share-based payments. And we also talked about what? Assets held for sale. They are exceptions to measurement principle because measured at as per guidelines of respective Ind AS. For example, asset held for sale relates to Ind AS 105. So assets held for sale shall not be measured at fair value, rather as per the guidelines set out in Ind AS 105, measured as per guidelines of respective Ind AS. Correct? Then, now we come over to another important aspect, that is 8th step, measurement of goodwill. Measurement of goodwill or gain on bargain purchase. In order to compute, where is the pen? In order to compute goodwill or gain on bargain purchase, what you need to do? A. First write 100% of identifiable, net identifiable asset. Net identifiable assets. From there on, subtract non-controlling interest. this balance which is now remaining reflects the share of acquirer in the net assets of acquiree. Correct? Now we shall have to subtract again consideration. How much we paid to acquire this much of assets, you can say that way out. The resultant figure will be either goodwill or gain on bargain purchase, depending upon the fact whether this amount exceeds this one or not. Suppose if this one would exceed, there will be gain on bargain purchase. If this would be less than this amount, of course, then in that case, it would be a goodwill. I will give you an explanation for the same. However, we have created a separate section wherein we have incorporated nearly 14 questions simply on computation of goodwill, non-controlling interest or gain on bargain purchase. Just to elaborate this point so that you understand it better, just wait. We have to settle down the sheets also. We presume there is a company by the name of A and there is another company by the name of B. Correct? We further presume we have invested or acquired 80% stakes in company B. In order to acquire 80% stakes, we paid a consideration of rupees 15 lakhs. Let us say we paid a consideration of rupees 15 lakhs. Correct? Now, when we acquired B Limited has net identifiable asset, NIFA, in short form I am writing, net identifiable asset with a fair value of rupees, say, let us say for simplicity it is 10 lakhs for simplicity's sake. Correct? So how to compute the goodwill? First of all, in order to compute the goodwill, just a moment ago I said, first of all I need to write 100% of fair value of net identifiable asset, in short form NIFA, net identifiable assets. Net identifiable assets 10 lakh. Now, less non-controlling interest. Non-controlling interest is 20% because we have acquired 80% stake, so 20% of 10 lakh. This 10 lakh, what does it suggest? It suggests that out of 10 lakh worth of net assets of B, 20% do not belong to us, or should I say 20% belongs to other shareholders. We are left up with, although we are not going to write anything for it, but you must understand that this 8 lakh reflects the share in the net assets of B Limited of A Limited. Out of 10 lakh worth of net assets, A Limited will command a stake of 8 lakhs, correct, because we have acquired 80%. So when we acquired 80% stakes in B Limited, indirectly we got 8 lakh worth of asset. But unfortunately, we paid a consideration of 15 lakhs. That means we paid more. Because you paid more and got less, you got only this much worth of assets, whereas you paid 15 lakhs. So you incurred a loss this time and it will be termed as goodwill. You got my point or not? This is how we are going to compute goodwill and gain on bargain purchase. Lots of questions we are going to do later on. Correct? Then ninth is bargain purchase. I have already talked about this at length, bargain purchase. Bargain purchase itself means gain on bargain purchase, first of all. And I did tell that generally bargain purchase is not possible, correct? However, if the entity is under some pressure, then we may have gain on bargain purchase. Logically, gain on bargain purchase is not possible. Is not possible. Is it? It is not possible. However, in rare circumstances, in rare circumstances, that is, when acquiring is under some compulsion, such compulsion could be legal, economic, whatever it might be, legal compulsion or economic compulsion, then gain on bargain purchase, GOBP, could arise. However, standard further says that if there will be gain on bargain purchase, we need to have a relook. We need to just reassess whether in real terms there is gain on bargain purchase or not. Then consideration. We talked about that also. Consideration. Consideration 1 shall be measured at fair value only. Shall be measured at fair value. And mode of payment could be anything. The mode of payment could be cash, share capital, equity preference. You can even give some options. You can also give warrants. You can also give business. You can also give some assets, anything, to settle the amount of purchase consideration. Correct? It is a common thing. Then standard also talks about business combination achieved by way of stages. Business combination achieved by way of stages. Yeah, this is the point we discussed earlier, isn't it? It is also known as step acquisition. It is also known as step acquisition. If an entity if an entity is already an investor in other entity, and later on it makes additional investments additional investments and which provides and that provides control to it, then it is a case of step acquisition. It is a case of step acquisition or business combination achieved by way of stages. Correct? For example, say there is an entity by the name of A, another entity is B, and it is having entity A, let us say, invests in 35% equity, correct? 35% equity on 30th June 2020. Next year starts, and next year, say on 1/7/2021, it makes additional investment of 40%. So on this date, it will have 75% stakes and control. Is it clear to you or not? Now, acquisition related cost are the costs such as finder's fee, advisory cost, legal, accounting, valuation, professional or consulting fee, consulting fee, journal administrative cost, etc. Such costs are expensed in the period in which are incurred. So this is all we discussed in the first two sessions. We have written each and every bit of TET, and in the upcoming session we have lots of things to discuss, and we will start with the practicals.